Hello everyone, good afternoon. We've got another session for Borak Bersama Maybank. I would like to call it my kopitiam, but I don't have my copy right now. Here on our, basically our second session here, we've got Mr. Desmond Ch'ng, our senior banking analyst based here in Kuala Lumpur. I think he has been inundated with calls right now, Des, with all our clients talking about what's happening. So I think this will probably be timely for our audience. Again, I just want to say thank you to everyone here who's joining us for this call. I think it's very, very important that we hear Desmond's thoughts on what's happening. So just a recap, as we know, we've not been living under bawah tempurung or living under the rock, but we've seen some headwinds with some banks in the US. We've got Silicon Valley Bank. I think we've got Signature Bank. We've got First National Bank. Sorry, it's First Republic Bank. So sorry, yeah. But I think we'll probably be discussing that on what has happened to them. Okay. So let us kick off. Des, what do you think about Silicon Valley Bank and basically your thoughts on some of the other two, Silvergate and Signature as well?
Yeah, hi Naguib. So essentially to date, we've actually seen 4 banks default in the US. And of course, the more well-known one at this point in time is Silicon Valley Bank. So a little bit of background about the bank itself. It's actually the largest bank in Silicon Valley, and it's the 16th largest in the US in terms of asset size. So this bank itself, it was essentially a banker to tech companies and startups in the US. It specialized on that. So over the past few years, it actually benefited from the pandemic tech boom in the sense that deposits from these tech companies actually flowed into the bank in quite a large way per se, and the bank essentially invested these funds in US treasuries and asset-backed securities. Now, one of the problems that arose during this period is that the Federal Reserve started to raise rates in the US. And this, coupled with the fact that the tech companies actually went through a down cycle in recent years and the cash burn rates remained high. So what we saw is that they started to withdraw heavily on their deposits themselves. And in the case of Silicon Valley Bank, they actually had to liquidate some of their investments at the time of rising interest rates, which resulted in mark-to-market losses being realized on these investments themselves. So the bank actually tried to raise funds a few weeks ago, but the withdrawals from depositors was pretty strong. It essentially had to cancel the share sale itself. They tried to look for a buyer, that didn't succeed. So at the end of the day, the regulators intervened and they actually shut it down and placed it under receivership actually. So in short, the problems that SVB faced can be summarized as follows. It had a very concentrated depositor base with high cash burn rates, essentially to tech companies and startups. And it had overexposure to investments at the time of rising interest rates, which they had to liquidate due to the heavy deposit withdrawals that they saw. And that essentially resulted in the second largest default in US history. The largest one is actually Washington Mutual back in 2008. And so this comes in as the second largest per se. The thing is, you mentioned some of the other banks like Silvergate Bank, Signature Bank, and First Republic Bank. So very quickly on these banks as well, just to give you a little bit of flavor. In the case of Silvergate and Signature Bank, they're deemed to be crypto-based banks to some extent, in that they focus mainly on crypto customers. At least that was the case in Silvergate Bank. In the case of Signature Bank, they actually entered the crypto space back in 2018. But given the problems that the crypto market actually faced last year, so this also resulted in heavy withdrawals from these two banks, and eventually, these two banks faced liquidity problems. And recently as well, we saw this bank called First Republic Bank, which is a San Francisco-based bank, which caters mainly to high net worth individuals. That also saw heavy withdrawals due to concerns over its high levels of uninsured deposits, its high levels of unrealized losses, and low capitalization. It borrowed money from the Fed, and recently 11 banks actually injected 30 billion into the banks just to keep it afloat, actually.
Point which I just want to ask outright. I mean, if you know, you also rightly mentioned the Fed has come and stepped in, intervened, so to speak. But well, I guess I would call it a bailout. But what do you think? Whether this is healthy or not?
Yeah, so coming back to your earlier point, which I want to clarify as well, is that, when you question as to whether this is actually a systemic issue for the banking system in the US, I'd like to point out that what we are seeing seems to be quite unique in that these banks had very concentrated depositors in particular sectors. And especially if you talk about banks like Silicon Valley Bank, where the customers were mainly those in the tech sector, which had high cash burn rates and high requirements for cash per se. So, they needed to withdraw their money on a more regular basis. And this kind of depleted the deposits of Silicon Valley Bank itself. And as I mentioned, they had to liquidate their investments at a loss to cover some of the liquidity issues that they faced. So to a large extent, it's quite unique in nature, and I don't think it's a systemic risk at this stage. But yeah, so the Fed has actually stepped in to try to calm the markets per se, and they've announced that all of the depositors will have access to their deposits, and not just the portions that are insured, which is about 250,000 US dollars. It will provide financing to banks to meet depositor withdrawals via a new program, which they call the Bank Term Funding Program itself, which offers loans of up to 1 year. And so the loans are backstopped against a 25 billion commitment from the US Fed, from their US Treasury Exchange Stabilization Fund itself. So it should provide a little bit more comfort to depositors that there is backing from the Federal Reserve.
That's the US, guys. Okay, let's come closer to home. I think you cover Malaysian banks, and you're the go-to guy pretty much with pretty much all our clients here. But let me ask you outright: would we be concerned that this is going to hit the local banking stocks?
Yeah. So what I've been telling investors is that at this point in time, the Malaysian banks are quite isolated from what's happening in the US and Europe. And in fact, the financials are pretty strong at this stage. There are several points I would like to make. Firstly, if you take a look at the interest rate increases in Malaysia, they've not been as dramatic as they have been in the US. So this means that the mark-to-market losses that the banks have to face here in Malaysia are a lot smaller than they have been in the US. Secondly, if you take a look at the likes of Silicon Valley Bank, they were quite unique in that a lot of their funds were parked in investments rather than in loans. In fact, the portion of investments was about 57% of total assets, and this compares against about 16 to 25% for Malaysian banks. And this was an exacerbated situation amid rising interest rates, whereby you have to mark to market these investments, which resulted in losses or heavier losses for SVB when these investments were liquidated. To note that essentially the mark-to-market losses for Malaysian banks at this point in time have been relatively small. And as I pointed out to you, given that the interest rate increases have not been as dramatic, so we don't expect the mark-to-market losses to be large. Another point to bear in mind is that a large portion of the investments of Malaysian banks are held in government papers, which provide a lot more stability. They are more liquid in nature, and essentially, if you hold them to maturity, they're redeemed at par. So there is no realized or unrealized losses on these papers upon maturity itself. A point also to note is that Malaysian banks have a very stable depositor base, which is fairly diversified as well. On average, the retail depositors account for about 42% of total deposits. Businesses make up about 41%, and government authorities and other depositors another 17%. So this actually buffers against any particular or any run on the bank that the banks may face, which means that the deposit base actually protects them from a large outflow from any particular group at any point in time. A more important point to note is that liquidity is not an issue for the Malaysian banks. If you take a look at the loan to deposit ratio, it's currently about 92%. If you look at the loans to fund ratio, which is essentially loans divided by customer deposits plus borrowings, that's a lower 88%. Moreover, the banks in Malaysia have to adhere to this liquidity coverage ratio, which currently stands at an average of 145% for the banks in my coverage versus a minimum requirement of 100%. Now, very briefly, the liquidity coverage ratio, the formula is stock of high quality liquid assets divided by total net cash outflows over 30 days. What it means is that the banks have to keep a stock of high quality liquid assets, which are typically your government bonds, to buffer against any run on the bank for 30 days itself. So a level above 100% is comfortable, and the average for the banks in my coverage currently is about 145%. So they're well above the minimum requirement. And finally, to note as well that the capital ratios are quite comfortable for the banks, averaging about 13 to 15% for the banks in my coverage.
Okay, thanks, Jess. I think pretty much just to snapshot, I'm comforted. I think the audience and all our investors are, especially in Malaysia. So again, just highlighting what you want, jotted this down. Interest rate hikes are not aggressive. Pretty much all our banks have different asset portfolios. Malaysian mark-to-market investments or bonds holdings are not as high. We've got a diverse pool of depositors, all these Asian depositors. Again, 65% of Malaysian depositors are long-term. So again, our capital ratios are comfortable. So I think that is pretty much the comfort that we should all take, that the Malaysian banks should be okay at this point in time with regards to this concern that's happening. So again, thanks everyone for joining us. I think this has been an eye-opener for our audience investors. Thank you, Desmond, for sharing. I'm sure that we will be speaking again soon. I think we will be definitely monitoring what's going to happen in the coming weeks and coming months with regards to this. To everyone else, you can get our latest market news and research from our Telegram channel, Trade with Maybank. You can also reach out to our respective, sales representative, even as well as our digital sales team. Also, just to highlight, if there's anything actionable, Desmond hasn't mentioned this, but I'm just going to remind everybody, he likes CIMB, he likes AMMB, RHB, Hong Leong Financial Group, Hong Leong Bank, and Lions Bank. Remember, stay ahead and trade smart. We are available to you again, as mentioned, on the Telegram channel, LinkedIn, as well as YouTube. Till the next Borak Bersama Maybank, this is Naguib Hussin signing off, and talk to you soon.
Do 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 do.